In this video, I want to talk about equity ETF investing. A little bit about what I think of it, what I think the benefits are, places I look for potential ETFs to invest in, and also tools on how to compare different types of funds or strategies. For those of you who are new to my channel, my name is Jared Ayers. I am a CFA charter holder and have created this channel to share with anyone who's interested the ideas, concepts, strategies that I use to invest for myself. So I just want to talk briefly about the benefits of ETF investing. Now myself, I don't invest necessarily in equity ETFs. I'm more of a stock picker. As I said, I'm a CFA charter holder. I love to analyze stocks. I love to read financial reports, all that stuff that the average person I think probably finds either very boring or just too overwhelming to try to get their head around. So, in the past few years, obviously ETF investing has become very popular for a number of reasons. So I am often getting questions about this topic, so I thought I would just do a video on it to try to address some of the things that I hear people asking about. So maybe stating the obvious, but ETFs obviously are cheap. That's probably one of the biggest benefits. They are designed to mirror usually an index or a basket of equities, and they do that passively, and the fees are very, very low. So if you are looking at an ETF versus a mutual fund, if the mutual fund's fees are even as low as say 1 or 1.2% versus an ETF which is maybe 0.2%, you could be looking at a 1% spread there. That means the mutual fund, just to be on the same level as the ETF, has to produce returns that are on average 1% higher year in, year out. So that is not usually a feat that funds, mutual funds over time have been able to do very well or easily, certainly not for long periods of time. So generally speaking, ETFs do have that advantage. They basically match the performance of the market, or whatever market that is you're trying to mirror, and they do it very cheaply. Second one, of course, is that you don't have to know much about investing at all. You can just buy the market. Warren Buffett is a huge supporter of that, and I completely agree. If you don't have the time, the stomach, the knowledge to do the work yourself to try to figure out which are the winners, then it's much, much easier, much more cost effective, and in the long run probably much more profitable for you to just go with an ETF of your choice. And we'll get into a little bit about what ETFs I think might be good places to start with in a little while. The other benefits, of course, if you don't have a lot of money, if you're starting out investing, it's an easy way to get into the market. It's liquid, it's cheap, but it also allows immediate diversification. You don't have to go out and buy 10, 12, 20, 50 stocks. You just buy the ETF, of course, and boom, you have your diversification. From my own perspective, of course, I like to know what it is I'm buying. I want to make sure I know what the price I'm paying for it is, but generally speaking, passive investors, it's a good strategy. I mean, just to buy the market, it doesn't really matter when you do get into it, as long as you are into it and you stay into it. Some of the sell-offs we've seen recently are almost like passive investors acting as though they are active investors, and sometimes if you are into this sort of long-term hold the market type strategy, that's often the best situation to be in, is just to hold on to it. I mean, even if you came into the market at the peak prior to the 2008 crash, you'd still be better off now, this far down the road. So that's something to consider as well. The other of course benefit of ETFs is choice. So there's almost maybe too much choice in some respects. There is basically an ETF for almost every strategy, every type of exposure in terms of markets or sectors or segments or industries or what have you, in the equity space. there's just so much you can choose from. It's almost endless. So maybe too much choice, but definitely there is choice out there. So those are some, I think, some of the biggest benefits I see in being able to invest in this type of vehicle for sure. So there are some things that I think every ETF equity investor should consider before jumping into an ETF. Like I said, there's a ton of choice out there, and with choice comes some types of ETFs perhaps that are a little bit on the dangerous side. So for starters, there are ETFs out there that use leverage. So you'll see sometimes 2x or 3x next to the ETF's name, and that usually means that they're using some form of leverage to basically heat up the potential gains. But on the downside, of course, those potential gains can also lead to potential losses. So just be aware that when you're looking at ETFs that are claiming to provide kind of that 2x or 3x whatever the market, and then there's ETFs that will go short as well, so you can go 2x or 3x short as well. So again, just understand what it is the fund is actually investing in. If you don't understand what it is the fund's actually investing in, it's probably a good indicator that you should probably stay away. I think one of the number one rules of investing is understand what it is you are actually investing in. That usually helps people avoid the majority of losses and or bad decisions. So the other thing to consider, I guess, kind of is on the same page, is ETFs that do claim or that do, I guess, chase alternative strategies. So sometimes there'll be a blend of different things within the ETF. It may look like an equity, but they'll have like a little plus or some sort of little indicator that maybe there's more to it than just the pure play that you think it might be, or it might be marketed a little bit differently. So again, you want to make sure that what you're getting or what you're buying is actually what you think you're buying. So always good if it's being marketed as sort of an alternative strategy, or again, just not super clear. Understand again what actually is in the fund. A good source to find out that information is if you go to the fund's website. Most big banks or either big brokerage houses and stuff that do issue ETFs will have pages for those ETFs. On those web pages, you'll have usually a link to a fact sheet, and those fact sheets usually give you a good indication of what actually the strategy is and what the holdings are of the fund itself. So a good place to just check out what is actually being held by the fund. And then of course the third thing to consider when ETF investing, and this kind of will help you with the first two, is understanding exactly what your investment strategy is. So as an equity investor, even if you are just investing in ETFs, understand what is it you're trying to achieve by making those investments into equity ETFs. If it's just you're just trying to find a group of really strong companies, whether that's very, very broad or maybe a little bit narrow, or trying to get exposure to different sectors for whatever reason, and you may have your own reasons. I guess just really understanding what it is you're trying to achieve, and then that will usually narrow the list of options for you when looking at what you might want to find in terms of equity ETFs that are suitable for, again, your strategy. So in terms of equity ETFs that I might consider myself, if I wanted to shy away from what I do from a stock picking standpoint. So if I just looked at my own investment strategy and said, okay, well, if I want to go into ETFs, what might I look for, or what ETFs might be suitable for what I'm trying to achieve? For me, I'm always looking at quality businesses, businesses that have a high probability of growth and a track record, high return on equity, reasonable debt levels, very good growth trajectory, solid management, etc., etc. So, one of the ones that I would probably consider myself, and this may be pointing out the obvious, but is the S&P 500 ETF SPY or some equivalent of that. The S&P 500 is the basket of the largest companies, obviously, in the U.S. And it has, just by its mechanics, it has a way of always adding the companies that are, the next big thing, and dumping the companies that have fallen from their former highs. So if you looked at the S&P 500 now, you see the sort of FANG stocks all sitting there, in probably the top 10 or 20 now. I'm not sure, I haven't looked at it in a little while. In terms of sort of market cap, percentage of the index, and versus if you say looked back, I don't know, into like the 90s and what the S&P 500 then looked like, might see more companies like, in the Time Warner, Coca-Cola, Warren Buffett-esque type companies back then may have had a more prominent position in the S&P 500. So it's just, it always sort of is a moving mix of the, I guess, latest and greatest, and whenever you're holding on to that, that ETF is changing its composition in terms of the companies that really are growing and taking over in different industries, in different spaces, and it actually is sort of letting go the companies that have, say, fallen from industries that have been taken over by other advances in technology or what have you. So it's a good place. It's a broad index. It's a very liquid index. There's all kinds of things that get traded around it, options and those types of things, of course, if you're interested in that type of thing. But the ETF itself, I think, is solid. It represents for me a basket of very high quality companies, albeit a very large number, and certainly you don't know what price you're paying for all of them whenever you're buying it. But I guess the ETF strategy itself is not meant to worry about that. So that's one of them that I would consider for sure. The second ETF that I may look to, and this is sort of similar to the S&P 500, is a ETF called MOAT. It's I think VanEck's wide MOAT ETF. I think it's sponsored by Morningstar. Anyway, it's the symbol, the ticker is MOAT. I'll put all this in the description as well. But basically, it looks at companies that have what is termed a wide moat. So, in other words, in sort of Buffett language, companies that have some sort of competitive advantage that makes it very difficult for competitors to, basically break down or compete with them. The performance of that ETF, isn't far off from the S&P 500, so it kind of has a similar traits to it. I believe the index itself is a little bit smaller, of course, but really tries to focus on companies that do have some sort of competitive advantage to them. So again, sort of like the companies I'm trying to find when I'm looking for individual stocks to pick. That's another ETF that I think might be worth looking at if I had that hat on. And the third ETF that also kind of mirrors part of what I'm trying to achieve is actually more of a spin-off ETF. And in one of my past videos where I shared where I hunt for stock ideas, stock spin-offs is another area that can be very, very profitable when looking at individual companies. So an ETF that sort of has a basket of companies that have been recently spun off, to me represents probably a good place to start if I'm trying to go after that kind of strategy. Again, right, it's still a basket at any point in time, so you don't know what those companies have been bought for when you're purchasing that ETF, or what the price of them are relative to their valuations, etc. But at least I know, if I know the sort of reasons why stocks that have been spun off have a high probability of increasing in value. That's another one that I might look at in terms of reflecting part of what I'm trying to achieve in my investment approach. Again, it all comes back to what is it that I'm trying to achieve? What is my investment objective? Why would I want to, or what am I trying to get in terms of companies in my equity portfolio? So those are three that I would probably look at. So SPY, MOAT, and the Guggenheim Wide Moat ETF, which I think the symbol is CSD. So those ones, are a good place for me to start. Obviously, that will be up to you, anyone watching this, what you may decide is best for you. But I do also want to share with you a little tool that I do use when evaluating ETFs or any kind of strategy represented by ETFs. It's super simple, it's super easy. You probably used it yourself plenty of times, but what the heck, I thought I'd show you myself just to put it out there. So as mentioned, I do use a little tool, or there is a tool available that anyone can use. It's free, it's easy. It's really on probably any of the finance websites. I use Yahoo Finance, so right here I've got SPY up on my screen. I can then go into the chart, can make that full screen, and here you can see the history of the S&P 500 ETF SPY. This looks like it's probably don't know, it's probably the 6th month or something like that, but let's just make it 2 years here. So to this you can then add whatever other comparable you want to do. So let's look at MOAT, because we talked about that one. Save changes, and we'll also add in the spin-off ETF that I was talking about. So here you can see a comparison. It will always start all three, or however many you want to compare at a point in time, based on what you're selected up here. So you can actually do date intervals, or you can just choose whichever time period you want. So as you can see here, the purple line is of course the spin-off, so it was above the other two, or a little bit here, but obviously it's trailed off down there. The second one in terms of rank is the S&P 500 SPY, and MOAT actually is a little bit higher over the past 2 years at a 25% increase. So again, you can choose whichever time period you want. That's 1 year, that's year to date. So at certain periods of time, they may switch. They do obviously track fairly closely to one another, so indicating that the strategies are probably not that far apart, at least at certain times. Let's look at the 5 year. Ooh, yeah, okay. So probably not a great strategy, or at least this ETF tracking sort of a basket of spun off ETFs, maybe not so great, but again, MOAT seeming to have outperformed the S&P 500. So again, not over every single period, and let's just click on the max button there just to see. Yeah, there we go. Okay, so again, so maybe a little bit there in terms of a higher performance from the CSD, or the spin-off ETF. But again, this is just to showcase the tool itself. I was surprised that someone I was showing one of my strategies to recently, I'd never seen this before, but it's a quick little way of comparing different strategies or ETFs just to see how they compared, or how they performed in the past. Of course, the past performance is never always an indicator of future performance, but if you're looking at various strategies, then it's one quick and dirty way of seeing how different ETFs, for instance, have performed relative to one another over a period of time. So I hope that was helpful. So I hope you enjoyed that video, or at minimum found it useful. If you liked the video, please by all means hit the like button. If you want to leave comments as to other topics you'd like me to cover in the future videos, please don't hesitate to leave comments below. If you are not yet a subscriber but would like to see similar content that I'll be covering going forward, or past videos that I have already published, by all means do hit the subscribe button as well. Until next time, thank you very much for watching.